The last thing I want to talk about in this series is what we call the Loanable Funds model. So this is a super simplified version of financial markets, and we're trying to model or explain the long-run average level of real interest rates and investment spending. So our national savings equals investment model does that somewhat, but now we're going to go ahead and add some more detail. And this is actually just a nice supply and demand model, and you've got some experience working with supply and demand models. The quantity here is the quantity of investment spending and national saving. And the price here is the real interest rate. Because the interest rate is, of course, the price of a loan. We're going to have a supply of loanable funds, and the supply comes from national saving. And of course, national saving equals GDP minus consumption minus government spending. The demand for national saving comes from borrower investors. And when interest rates are high, then lots of projects don't look profitable. They don't look worth it. So that's going to mean that we're going to have a low quantity demanded. If interest rates are low, then lots of projects start to look profitable because it's easy to get financing and it's cheap and so on. So we're going to have a high quantity demanded. On the other end of it, if interest rates are low, then saving doesn't look very appealing, and people will tend to not do very much saving. But if interest rates are high, then saving is going to look more appealing and people are going to do more of it. And so we have this model, and we have some predicted equilibrium real interest rate and equilibrium quantity of investment spending. And so far, so good. So everything we talked about before that shifts national saving is going to potentially shift the supply curve left or right. Something that causes national saving to be lower is going to shift this supply curve to the left. Something that causes national saving to be higher is going to shift this supply curve to the right. If firms want to undertake more investment spending because they're more optimistic about the economy or because exciting new technologies have become available, then the demand curve is going to shift to the right. If, on the other hand, firms become less eager to undertake investments because they've become more pessimistic about the future or because there are no exciting opportunities to make investments, then the demand curve is going to shift to the left. Using this, let's think about the phenomena called crowding out. So I talked earlier about the relationship between the budget deficit and the level of investment, and we can use this diagram to understand that. Crowding out is the idea that a bigger budget deficit causes lower investment spending. And how does this play out in the diagram? Well, a bigger budget deficit means a lower level of national saving. So that's going to shift this supply curve to the left. And we're going to see that we both have an increase in real interest rates and a fall in the amount of investment spending. And this can happen sometimes. It was alleged that one of the reasons why, or it has been alleged, that one of the reasons why investment spending has been relatively weak recently, in the sort of 2008-2007 period, is that we've had large budget deficits during that time. But while it's true that investment spending has gone down, we haven't seen an increase in interest rates. We've actually seen a decrease in real interest rates. And so that's actually more consistent with a leftward movement of the demand curve. Sort of overdid it here a little bit. A leftward movement of the demand curve because firms are pessimistic, say, about prospects for future economic growth. So I think it's just not a tenable story that crowding out is the cause of lower investment spending, because if that were true, we would have to have higher interest rates because we would have this supply curve shift.